For more than a century and a half, one name in American finance carried the weight of the frontier itself: Wells Fargo. It was born in 1852 in the chaos and promise of gold rush San Francisco, founded by two men, Henry Wells and William Fargo, who had already helped launch American Express just 2 years earlier. And here's the thing I love about that stagecoach that became their emblem. It wasn't just marketing. It was a promise. In a young, unstable nation, there was supposedly one institution you could trust to move your gold, your letters, your fortune safely across a wild and unpredictable land. That trust turned out to be remarkably durable. Fast forward more than a century, and Wells Fargo had grown into one of the four titans of American banking, standing shoulder to shoulder with J.P. Morgan Chase, Bank of America, and Citigroup. It held nearly $2 trillion in assets. It claimed, proudly, to serve one in every 3 American households. And in the early 2010s, it pulled off something I still find kind of astonishing. For a stretch of time, Wells Fargo was the most valuable banking company on the planet by market cap, worth more than even the mighty J.P. Morgan. But the raw numbers don't really capture the aura this bank had. Wells Fargo wasn't just big. It was admired. It was the bank Wall Street held up as the model of how banking should be done. While its rivals chased risky trades and complex financial instruments, the kind of stuff that helped blow up the whole system in 2008, Wells Fargo told a simpler, more reassuring story. It was a boring bank, and boring was beautiful. It made money the old-fashioned way, by serving ordinary people, selling them checking accounts and savings accounts and mortgages and credit cards. Steady, reliable, safe. Honestly, that reputation is what makes the rest of this so hard to swallow. Nobody endorsed that story more powerfully than Warren Buffett. The most celebrated investor in the world poured billions into Wells Fargo and praised it as one of the best-run banks in America. And when the Oracle of Omaha speaks, the financial world listens. His blessings seemed to confirm what everyone already believed. Wells Fargo was different. Wells Fargo was the good one. At the heart of that reputation was a strategy the bank had turned into an art form. They called it cross-selling. The idea was elegant in its simplicity. If you already have a customer, why sell them just one product when you can sell them 5 or 6 or 8? A customer with a checking account could be sold a savings account, then a credit card, then a mortgage, then an insurance policy. Each new product deepened the relationship and deepened the profit. Wells Fargo pursued this so relentlessly that it coined an internal slogan: 8 is great. The goal was 8 products for every single customer. And the market rewarded them for it, because cross-selling looked like proof that customers loved the bank so much they wanted to buy everything it offered. That was the illusion. And I'll admit, it was a beautiful one. Because beneath that gleaming reputation, hidden inside the very machine that generated all those admiring headlines, something had gone catastrophically wrong. Over more than a decade, employees at Wells Fargo quietly created accounts that no customer had ever asked for. Credit cards issued without consent. Savings accounts opened with forged signatures. Real people, real customers, unknowingly enrolled in products they never wanted, charged fees they never agreed to. And when the full scope of it finally came out, the number floored me. As many as 3.5 million fraudulent accounts. 3.5 million. This is the story of how one of the most respected financial institutions in America became the site of one of the largest consumer frauds in banking history. And it raises a question that bothers me far more than a simple tale of greed. This was not the work of a single villain, some rogue executive scheming in a corner office. There was no dramatic confession, no smoking gun memo dropped by a whistleblower on a witness stand. What happened at Wells Fargo was systemic. It was built into the culture, the incentives, the relentless pressure that flowed from the top of the organization all the way down to the branch teller. And the truth didn't come out through some courageous admission. It leaked out slowly, reluctantly, through fines and investigations and regulatory settlements. This is how the illusion finally shattered. To understand how it all went wrong, you first have to understand what Wells Fargo believed made it great. And the answer comes down to a single, almost unremarkable phrase: cross-selling. On the surface, it sounds like nothing. Cross-selling is just the practice of convincing an existing customer to buy another product from you. You walk into the branch to open a checking account, and before you leave, someone suggests a savings account, then maybe a credit card, a line of credit, a mortgage, an insurance policy while you're at it. Each additional product deepens the relationship between the bank and the customer. And to Wells Fargo's leadership, that relationship was everything. The philosophy had roots that stretched back before the modern company even existed. When Norwest Bank effectively acquired Wells Fargo in 1998, taking on its storied name and stagecoach legacy, it also brought its own gospel of selling. Richard Kovacevic, the former head of Norwest who became chief executive of the combined company, was the true architect of this obsession. He didn't even like calling Wells Fargo a bank. He preferred to think of it as a store, a place where financial products were sold like goods off a shelf, and where success was measured by how much each customer could be persuaded to carry home. I find that framing telling, because a store doesn't have the same duty of care that we expect from the place holding our money. The metric they used to track all this was called the cross-sell ratio. It measured the average number of products held by each household, and over the years it became something close to sacred. Wells Fargo set an internal target of 8 products per customer, a goal captured in that slogan echoing through branches and boardrooms alike. 8 is great. It was catchy. It was memorable. And here's the part that gets me. It was chosen, at least in part, because 8 rhymed with great. That was the level of thought behind a number that would eventually drive millions of Americans into accounts they never asked for. In the 2010 annual report, CEO John Stumpf personally signed a letter to shareholders celebrating the progress. At the time of the Norwest merger, he noted, the average customer held 3.2 products. By 2010, that figure had climbed to 6.1. The goal, he reminded everyone, was 8. And then, in an almost giddy tone, Stumpf suggested they aim even higher. Let's go again for 10, he wrote. 10 products per household. It reads like a coach rallying a team, not a banker overseeing the finances of 1 in 3 American families. That gap between the pep rally language and the actual stakes still strikes me as the whole problem in miniature. But why did any of this matter so much? Why did leadership treat a simple ratio as the beating heart of the company's identity? The answer lies in what Wall Street wanted to see. To investors, a high cross-sell ratio was a beautiful thing. It signaled loyalty. It signaled that customers were locked in, embedded, unlikely to leave. A person with 8 products at one bank isn't going to casually switch to a competitor. That meant predictable revenue, steady growth, and a fortress-like customer base that promised earnings for years to come. So the cross-sell number became a headline figure, reported quarter after quarter, picked apart by analysts, praised on earnings calls. It helped push Wells Fargo to a place no bank had occupied before. In the earlier part of the 2010s, Wells Fargo became the most valuable banking company in the world by market capitalization, passing even the mighty J.P. Morgan Chase. The stagecoach had outrun everyone. And at the center of it all was that magic ratio, climbing higher every year. Overseeing the engine that produced these numbers was Carrie Tolstedt, head of Wells Fargo's community banking division. Under her leadership, and within the tone Stumpf set at the very top, the cross-sell ratio got elevated from a business measurement into something like a religion. It was a number that had to go up. Always up. Never sideways, never down. Every quarter had to beat the last, because Wall Street was watching, and Wall Street does not forgive disappointment. But here's the problem with turning a number into a god. Somewhere far below the executives and the analysts, in thousands of branches across the country, real employees were being ordered to make that number real. And they were about to find out exactly how far they'd be pushed. Walk into any Wells Fargo branch during those years, and you'd see something that looked, on the surface, entirely ordinary. Tellers behind counters, personal bankers at their desks, a steady trickle of customers coming in to cash checks, deposit paychecks, ask about a loan. But underneath that calm surface was a machine running at a punishing tempo, and the people caught inside it were being squeezed in ways the customers never saw. The pressure arrived in the form of numbers, and the numbers never stopped. Each employee had a daily sales quota, a target for how many new products they were expected to move. Not weekly, not monthly, daily. And in a lot of branches, that quota got broken down even further into hourly check-ins. A manager would circle the floor or send a message demanding to know where you stood. How many accounts had you opened since the morning? How many since lunch? If you were behind, you heard about it. And then you heard about it again, and the message underneath every conversation was always the same. Catch up, or there will be consequences. And those consequences were real. Employees who missed their targets got kept after hours, forced to stay and grind out sales they couldn't make during normal business. A lot of that time went unpaid. Others were coached, disciplined, written up, and eventually fired. The threat of termination hung over the branches like weather, constant and unpredictable, and everyone learned to work in its shadow. To see how impossible this really was, forget the boardroom and look at the arithmetic of a single branch. A bank in a small town, or on some sleepy suburban corner, might get a handful of people walking through the doors on a given day. Some of them already had everything they needed. Some just wanted to drop off a deposit and go home. But the quota didn't care about foot traffic. It didn't care if the neighborhood was wealthy or struggling, packed or dead quiet. The target was the target, full stop. It had to be hit no matter how many actual human beings showed up wanting actual banking products. I keep coming back to that word, actual, because that's where the whole thing falls apart. The employees did the math, and the math didn't close. There simply weren't enough real people with real needs to feed the numbers coming down from above. So when honest effort ran dry, people reached for whatever was left. Bankers started calling their own family, begging relatives to open accounts nobody wanted, just to bump the count by 1 or 2. They leaned on friends. They opened products in their own names. And when even that wasn't enough, some stepped over the line management had, for all practical purposes, walked them right up to. The human cost here wasn't some abstraction, and this is the part that sticks with me. Former employees have described a workplace that sounds less like a corporate office and more like a pressure chamber. People broke down crying at their desks. Some got physically sick, throwing up from stress before or during a shift. Panic attacks were so common they were basically part of the scenery. These were regular people, a lot of them earning modest wages, boxed into a system that demanded the impossible and then punished them for coming up short. And when they tried to say something, the door slammed. Wells Fargo ran an internal ethics hotline, exactly the kind of channel that's supposed to protect a worker who spots wrongdoing and wants to flag it. But going by account after account, that hotline was worse than useless. People who called got nothing. Worse than nothing, actually. Some who reported the fraud were later fired, as if sounding the alarm had marked them as the problem instead of the misconduct they were describing. That's the detail that tells you the whole thing was upside down. Here's the uncomfortable truth sitting in the middle of all this. The employees who opened those fake accounts were, no argument, the ones who did it. But they were also victims of a structure engineered far above their heads. They got handed an equation with no honest answer and were told their livelihoods depended on solving it anyway. Fraud in that environment wasn't the moral failure of thousands of bad individuals. It was the survival mechanism the system had all but guaranteed. I don't say that to let anyone off the hook. I say it because you can't understand the scale of it any other way. So how does an ordinary bank teller manufacture accounts out of thin air? The methods weren't sophisticated. No hacking, no elaborate tech, but just access to customer data, a willingness to bend the rules, and the kind of desperation that comes from a sales quota hovering over you every hour you're on the clock. Start with one of the sneakier tricks, something employees called sandbagging. When a real customer walked in wanting a legitimate account, a banker under pressure might quietly sit on the request. Instead of opening it that day, they'd hold it, sometimes for weeks, until a new sales period started. By stockpiling genuine openings and releasing them at just the right moment, an employee could inflate their numbers when it mattered, hitting targets that were otherwise out of reach. It's gaming the system using real customers who had no clue their paperwork was being shuffled around behind the counter. Then there's pinning, and this one always struck me as the most invasive of the bunch. When employees created new accounts without a customer knowing, those accounts still needed a PIN to look active. So the employee just assigned one, usually 4 zeros. With that, the bank effectively held the keys to accounts the customer didn't know existed. Their money, their identity, folded into a shadow account they never asked for and couldn't get into. To keep these things hidden, employees got creative in ways that are honestly disturbing. They forged signatures on applications. They invented fake email addresses so confirmations and statements would get routed away from the real person and into a void. Some used their own contact info. Others used addresses that led nowhere. The whole point was making sure the customer never got a single notification that might tip them off. And if a customer did somehow trip over an unfamiliar account, employees were coached to wave it away as a computer error. A glitch. Nothing to worry about. It went further than empty accounts, too. In some cases, employees actually moved money, pulling funds out of a customer's real account and into one of the fabricated ones, no permission asked. They issued credit cards to people who never applied, using pre-qualified status to push plastic out the door with no application and no consent. Unwanted lines of credit showed up. Insurance policies the customer never wanted got quietly stapled to their names. And this is where the abstract fraud turned painfully concrete. A customer whose money got shuffled into a hidden account might suddenly find their real account short, which triggered overdraft charges. Those unauthorized accounts came with monthly maintenance fees, small amounts bleeding away month after month. Credit cards nobody asked for could ding a person's credit score just by existing, or by going unpaid because the customer had no idea the debt was even there. The LA Times documented one homeless woman signed up for 6 separate accounts, each draining $39 a month for services she never wanted and could barely afford. Read that again and let it land. Now think about the scale. When the story first broke, the number floating around was over 2 million potentially unauthorized accounts. Staggering on its own. But as investigators kept digging, the estimate climbed to roughly 3.5 million accounts that may have been opened without consent. 3.5 million. That number tells you everything. This wasn't a few rogue employees in one troubled branch. The same behavior turned up across thousands of locations, coast to coast, using the same techniques, the same workarounds, the same fake emails and forged signatures and zeroed-out pins. When the exact same misconduct pops up independently in that many places, following the same playbook, it stops being a bad apple story. It becomes proof of something systemic, something built into the machinery of the company itself. Which raises the question that really matters to me. Who built the machine, and how far up did the knowledge go? The uncomfortable answer is that the machine was running exactly as designed. So when the misconduct couldn't be buried anymore, the company did something remarkable in its cruelty. It turned on the very people it had pushed to the edge. Over the life of the scheme, Wells Fargo fired roughly 5,300 employees over the fraudulent accounts. Sit with what that number means. These were tellers and personal bankers, plenty of them on modest pay, working under quotas that couldn't be met honestly. They were handed an ultimatum, spoken and unspoken. Hit the numbers or lose your job. And when they did what the pressure demanded, they got fired for it, one by one, while the executives who set those quotas kept their titles, their offices, and their bonuses. That contradiction sat at the rotten center of the whole thing. The company had built a shiny public image around integrity. It talked constantly about ethics, about doing what's right, about caring for the customer. It ran an internal ethics hotline where employees could report wrongdoing they saw. On paper, it looked like a functioning conscience. In practice, it was closer to a trap. And people did report. They called the hotline. They flagged the pressure, the fake accounts, the forged signatures. They told managers customers were getting hurt. What did they get for it? Many were ignored outright. Others were told, more or less, that the real problem was their own weak performance. And some who spoke up were fired shortly after, whistleblowers punished sometimes within days of filing a complaint. The ethics line, the thing meant to catch misconduct, became a tool for finding and removing the people who weren't comfortable with it. That inversion is the part one can't get past. There was an even nastier layer to the retaliation. When employees left, whether they quit in disgust or got pushed out, the company could file a regulatory document called a U-5. That form follows a banking employee through the entire industry, a permanent record every future employer can see. In some cases, Wells Fargo used these documents to implicate departing workers in the very fraud the system had forced on them. A person who'd objected to the misconduct could end up branded on paper as a wrongdoer, effectively blacklisted from any other bank. And here's the part that leaves me cold. There was no clear way for those employees to fight a false or retaliatory U-5. No easy path to clear their names. The people at the very bottom got left holding the blame, with the door to their whole profession quietly pulled shut behind them. All the while, the language from the top stayed carefully controlled. Leadership framed the disaster as a matter of individual dishonesty. A few bad apples. Workers who failed to live up to the company's values. That framing did two jobs at once. It shielded the executives who designed the incentive structure, and it pulled attention away from the quotas, the mandatory hourly check-ins, the culture of fear that made honest work almost impossible. If the problem was just a handful of dishonest employees, then there was nothing fundamental to fix. You cut the workers loose and moved on. Convenient, isn't it? But that story could never hold up, not once you looked at how long the fraud had been running. It reached back to the early 2000s and kept going right up until the day it got exposed. Year after year, the signs were sitting right there. In the complaints, in the terminations, in the impossible arithmetic of the quotas. Leadership had every chance to look at the machine they'd built and ask a simple question. Is this pushing people to cheat? They didn't ask it. They raised the targets instead. They started talking about 10 products per customer. They threw parties for the numbers. I keep coming back to that because it tells you everything about who they were protecting, and it wasn't the customer. So when the reckoning finally came, it didn't come from inside. It came from outside. September 2016 is when the silence broke. The Consumer Financial Protection Bureau, the Office of the Comptroller of the Currency, and the Los Angeles City Attorney all lined up together and announced a combined penalty of about $185 million. For most Americans, this was the first they'd heard of any of it. Millions of unauthorized accounts, forged signatures, secret credit cards, pins quietly set to zeros, all of it landing in one announcement. Now here's the part that always gets me. In the quarter right before that fine, Wells Fargo had posted $5.6 billion in net income. Run the numbers, and that $185 million penalty works out to less than 3 days of earnings. 3 days. A bank this size could absorb that before the ink was dry. If the regulators wanted the fine to sting, the balance sheet didn't so much as flinch. What actually stung was the show that came next. CEO John Stumpf got summoned to Washington to sit in front of the Senate Banking Committee, and that hearing is where the whole scandal found its defining moment. Senator Elizabeth Warren stared down the man who'd signed those glowing annual letters, the guy who'd written, "Let's go again for 10," and she didn't soften a single word. She called it gutless leadership. She pointed out that thousands of low-level employees got fired while the executives who built the pressure cooker walked off richer than ever. She wanted him to resign. She wanted the Federal Reserve to step in and cap the bank's growth. And she landed a phrase that stuck to the place like glue, a scam driven from the top. Watching that clip back, you can see the moment his whole "few bad apples" defense stopped being an argument anybody believed. Because that's exactly what happened. His attempt to pin it on 5,000 fired workers just crumbled under the weight of the incentive system his own people had designed. Within roughly a month of the story breaking, he was out as chief executive. And this time it reached his wallet. The board clawed back $41 million from Stumpf. Carrie Tolstedt, the executive who'd overseen the very unit where all of this flourished, had millions clawed back too, though she was already halfway out the door toward retirement, set to leave with a fortune in shares and options. Years later, in January of 2020, Stumpf got hit with another $17 million fine and a lifetime ban from the banking industry. Hard to feel much sympathy there. But it didn't end with one man going down. The deeper investigators dug, the wider it got. This wasn't just fake checking accounts and credit cards nobody wanted anymore. Regulators found customers charged for auto insurance they never asked for, some of them pushed into delinquency and even losing their cars over it. They found borrowers hit with improper mortgage fees. This wasn't one scheme. It was a pattern stitched through the entire consumer operation, and that's the detail that turned my stomach the most, because insurance you didn't buy can cost somebody their way to work. The penalties climbed to match. The Securities and Exchange Commission and the Justice Department locked in a $3 billion settlement, more than 10 times that first fine. A class action from defrauded customers closed at $142 million. In December of 2018, the bank paid $575 million to all 50 states, plus another $480 million to investors who argued the phantom accounts had made the financial reports look rosier than reality. And then came the one that actually mattered, the punishment Warren had been demanding all along. The Federal Reserve did something you almost never see, an asset growth cap. Wells Fargo was barred from growing past roughly $2 trillion in total assets until it could prove it had fixed its governance and its internal controls. For a company whose entire identity was built on chasing growth, This was the deepest cut you could make. The machine that had gone after 8 products, then 10, was now legally forbidden from getting any bigger. There's a strange justice in that, and I don't say that lightly. Add up every fine and every settlement, and it still only comes to a few months of the bank's annual earnings. The money was survivable. It always was. What they couldn't just write a check for was the trust.